So today we're going to discuss, how family offices have, if at all, changed their investment philosophy post COVID-19. Now, obviously, if you just take a look at this topic, it seems that there is an inherent contradiction in it. So, long-term investment philosophy of an investor like a family office, which is typically expected to invest for multiple generations, why would it or why should it change at all? But on the other hand, we also know that COVID is something, the pandemic is something that is, maybe a black swan event, something that has happened today, something that nobody had expected, something which possibly will have very far-reaching consequences. So I think the real test of any investment philosophy, and especially in the context of family offices, whether that stands true even in cases such as COVID and the fallout of things such as COVID. So, while we will talk about all of that, I thought it'll be good to maybe just keep this discussion uh, more casual and more experience based rather than very technical, and talk about uh, how exactly the investment philosophy is structured. So more than that, I think what we are trying to do here is give you a flavor of what different family offices would probably be thinking today, post the entire pandemic fallout. Now, it will be a little, I'll be slightly out of my depth if I say that I know exactly how different family offices are thinking, because I can't, and every family office will behave very differently based on the way the family office is structured, the way the family office principles are structured, the way they think, the way their risk appetites are, etc. But what I'll try to do is just give you a broad overview of how a typical family office would think and what are the different considerations that they will have, and maybe talk about, based on my experience and my interactions with other family offices during the last 8, 10 months, what have I realized, of how these guys are thinking. So I will maybe use a presentation just to, and that also I don't want to use it for the entire duration of the talk, but I'll probably use it off and on. So I'll share it and then come back off it when it makes sense. So I'll start with the presentation to just give you a context of what I'm talking about, right? So on this one, I'm just trying to talk about what exactly do you mean by investment philosophy when it comes to a family office, and how does this investment philosophy get created in the first place, right? Now, uh, to begin with, obviously, you need to set the context, and you need to spend a lot of time talking to the family principals, the members of the family, everybody who's a stakeholder, and try to understand what is it that they think about investments, what is it that they think about managing their money, their family's money, what is the entire context, who are the family members, what are their individual aspirations, what are their combined aspirations, what kind of business does the family have, or multiple businesses that the family has, what is the next generation's ambition, do they want to continue in the existing business, do they want to do something new, um, what's the typical behavior like, are the members of the family very easily perturbed by what's happening, or are they really very solid when it comes to investments? So what is it that they really think about when it comes to losing money, for example? uh, Again, while by nature or by definition family offices would have a lot of money that they would manage, but then how much is a lot? Are they really okay with losing some part of it and still it doesn't really change their lifestyle? Or this is something that really provides for their lifestyle. So based on whether this is the entire, maybe there are some families who would have sold their businesses and got all the money which is being managed by a family office. For them, this money is extremely critical because that's probably their major source of income, if not the only source of income. There would be others who would have a core business
salaries, etc. So enough to take care of their lifestyle, and yet they would have some money which is being managed by the family office. So that portfolio that they have will probably not have too much of an impact one way or the other on their regular lifestyle.
So we need to understand that context as well. Then what is the legal context? So, legal jurisdiction in terms of countries, where do these people come from? How are the members of the family structured around the globe? Is everybody staying in India? Is it a multinational family? What kind of jurisdictions do they belong to? So all those are things which one needs to be careful about. Uh, then, while you're setting up the investment strategy, what are the different things that you need to do after you've set the context right? Now, after the context, when you look at the typical process of figuring out the asset allocation or figuring out the profile of an investor, I'm sure all of us have looked at a process where there is a risk profiler, there is a questionnaire, and then there are different kinds of risk profiles based on that questionnaire. And then each risk profile carries a different asset allocation. And you try and map every investor to one particular asset allocation. However, I think those kind of asset allocation strategies or those kind of questionnaire based strategies don't really work completely in the case of family offices or in the case of more sophisticated investors. It's more about mapping objectives. So, one investor is not necessarily somebody who belongs to one risk profile. So you will have multiple objectives as an investor, and especially when it comes to a large family, that's even more true, where they will probably do something where one part of their money is going to be for safety, one part of their money is going to be where they can take all sorts of risk and ensure that the capital grows at a high rate. There'll be something else which will probably meet their lifestyle needs, which will probably grow at the rate of the growth of the economy or slightly more than that. So based on the objective that the family has or multiple objectives that they have, you will map out different kinds of investment portfolios and different investment policies for each of these objectives. Once you've done that, you would obviously kind of try and test that and try and see if the family really understands that by doing some sort of scenario analysis and telling them that, okay, while you said that, say, 25% of your portfolio is or of your wealth is going to get into a growth strategy. So what does that really mean? Tomorrow, if I really create a growth portfolio for you, and markets fall, and something like a COVID happens, or something like a recession happens, you could really lose most of that money. Are you okay with that? So you do a lot of scenario analysis and try and ensure that the family understands what they are getting into when they're talking about different objectives and when they're talking about allocating to these different objectives. And obviously then you can dig deeper and try and figure out what is the kind of investment style that the family has. What have they done in the past? Do they have any constraints in terms of maybe not being able to invest in the sector in which they have their own business? Or do they have preferences in terms of maybe investing in the business or in the space in which they have their own business? So there will be different constraints and preferences. So you'll try and build that into the investment policy. And while you've done some scenario analysis, you'll also try and do that mathematically by doing some stress testing and modeling to show that the impact of changes in the economy, in the portfolio, how do those impact the family itself. And when you're doing the stress testing and modeling, probably you'll also include the family business into the overall portfolio, so that when something like this happens, something like COVID happens, or something like the recession happens, it doesn't just impact the investment portfolio of the family. It also impacts the core business of the family, which is what has happened over the last 8, 10 months, 12 months. So not only have the portfolios undergone changes, but we've also seen the core businesses across sectors getting impacted because of the pandemic. So when you're doing the stress testing and modeling, you should also include what could go wrong or go right with the core business of the family when you're talking about the impact on the money that the family has. And getting into nitty-gritties would also mean cash flow planning, And then how do you really monitor all these things? When do you really analyze whether it needs any change? How do you adjust small things? What sort of tactical deviations do you allow for? So all those minor things, although they sound minor, but believe me, it takes a lot of effort to really cross all the T's and dot all the I's, and which is what you need to do when you're talking about creating a very robust investment policy for a family office. And we'll come to the reason why this investment policy needs to be robust, and especially with context to current events. Now, when you're looking at doing all this, and you're looking at creating all these, mapping all these objectives, creating all these scenarios, ensuring that the family is really on board with what they have signed up for in the investment policy, how do you really decide what kind of assets to invest into? So you've got the objective, right? You've got a growth objective, you've got a safety objective, you've got maybe a lifestyle objective. But how do you figure out under which objective, what kind of asset classes or what kind of allocations should be there? And for this, broadly, we go to the basic concept of the modern portfolio theory. Most of you are aware of that, where we talk about something called an efficient frontier, which is nothing but the combination of the best risk reward assets. So all combinations of assets such that for a given level of risk, this is the maximum return, fall on the efficient frontier. So based on your risk profile, you would typically choose a portfolio on the efficient frontier so that for your level of risk, you can get the maximum return. Now, this is obviously assuming that there are only risky assets which are to be had. Typically, you mix the most optimal portfolio, which is the point M here, which is the market portfolio or the optimal portfolio, with the risk-free asset. So your portfolio would lie somewhere on this line, which is the capital market line. Now, anything on this line is supposedly the most optimal portfolio for your level of risk. So you decide what risk you can take on this axis. And based on that, you decide the mix of the risk-free asset and the market portfolio that you should have. So anything on this line here would be the most optimal portfolio that you would have. So this is basically theory, but in practice, what we are trying to say is that based on the level of risk that you want to take for a particular objective, you will decide what sort of asset mix should you have. And these asset mixes are characterized by their return and risk characteristics, right? So this is as far as what goes into creating the investment philosophy of a family office. Now, how does something like COVID impact it, or should something like COVID impact it at all, right? So I just kind of put together some quotes that I could find. Some of them I could find online, some of them based on whatever conversations I've had, and these are kind of representative of the kind of conversations that I've had over the last 10, 12 months. So as you can read here on this slide, I think most family offices feel that their investment philosophy is geared up for extremely long term, right? It spans across generations, and ideally it should not get impacted by anything that is happening in the in the world, because any short-term blip, whether it's a recession 10 years ago, whether it's COVID now, maybe it's something else 10 years from now, should ideally be that. It should just be a small short-term blip. And ultimately, it should not affect the way the family offices are thinking in terms of their long-term investment philosophy. Yes, it can create some short-term opportunities. Yes, it can create some short-term changes in how family offices invest, but in the long term, it should not really create an impact. At the same time, what you see is because of the extreme case that the pandemic has brought about, because of the extreme ways in which it has been dealt with by central banks across the world. You've seen liquidity flooding the markets, almost all asset classes being affected because of liquidity. there have been a lot of opportunities on the tactical side. Um, and you need to figure out what are those opportunities and whether your investment philosophy allows you to go and capitalize on those opportunities. Apart from those opportunities, is it also important to try and understand if your basic concept based on which, or basic foundation of creating this investment philosophy, has undergone a change? Are you now looking at a more resilient portfolio? Are you now looking at a higher risk aversion? So is there a rethink required in terms of what your risk profile is, or what your allocation to these different objectives are? Is the objective itself changing? Are you saying that, okay, maybe I don't need growth so much, maybe I want to preserve my wealth more than I am interested in growth? So are those things also happening? So while there is an institutional approach, and while you would think that because of the long-term nature of family offices, uh, a lot will not change, but at the same time, there are certain fundamental changes that can happen. Now, this is slightly more detailed in terms of what people are saying. What are the kind of tactical things that people are trying and are doing across family offices? There is a lot of change in terms of getting into private equity and venture capital. Things which are illiquid are offering very good opportunities for entry today. There are some safe investment options such as precious metals. People have even gone into cryptocurrencies and made a lot of money. We've seen a lot of volatility in the market, and across the world, people have looked at market neutral strategies that have focused on this volatility to make returns. Uh, Deals have started changing. There have been so many deals which have been available, both in terms of direct investment options as well as investment options that money managers are providing family offices. Structuring has become very lucrative for investors today, because while there is a lot of money which is there in the market, but most of that money is going to the public markets. There is so much dry powder which is there in the private and alternative markets. The fund managers have been trying to sweeten deals, have been trying to offer some very good bargains. There have been a lot of bridge rounds that have happened in portfolio companies on the unlisted side, which have given great opportunities. So there is a good time to buy for a lot of family offices who are looking to go long term in these kind of asset classes. Uh, the focus has shifted slightly, ever so slightly, not so much, because public listed equity and fixed income still continues to be a big part of the asset allocation. But there has been a shift in focus where people are now trying to see if we can look at debt structures, we can look at discounting, business incomes. Can we look at adding more liquidity to the portfolio and yet not really sacrifice the return too much? What is the kind of credit exposure do we need to take to be able to do that? So people have started becoming more innovative in terms of making these tactical calls, right? There have been a lot of surveys which different private banks have done across the globe. Citi, for example, had done this, where it has come out very clearly that while there are no longer long-term changes that family offices are considering after 10, 12 months of the pandemic, but there are some tactical changes that people are doing. Um, People are talking about direct investments over the next 12 months to a year. There are different sectors which have gained prominence. Obviously, healthcare, information technology. These are some very obvious sectors where focus has started to increase. So, while long term, most of the family offices are positioned where they are, but they're trying to ensure that they don't lose out on the opportunities. Similarly, BlackRock did another survey, which again talks about people trying to increase their allocation to private equity and private debt. While infrastructure is something that people are trying to look at. Liquidity has become a big concern because of the kind of valuations that equity are at, and the fixed income allocations being where they are in terms of the yields. Liquidity has become important, and at the same time, managing liquidity has become very costly. So how do you really maintain liquidity and at the same time not let it impact the overall portfolio return? It's become one of the biggest challenges that family offices are facing today. This has come out from the survey that BlackRock has done, right? So I think maybe if I were to sum up what I could see in terms of the observations that different people have, and my own personal observations in terms of managing the family office that I do, there are certain things that have happened, right? There has been a reassessment that a lot of people have started doing in terms of what do you want between growth and preservation of wealth. And this is especially relevant in the Indian context because India is a country where most of the wealth is really in the hands of the creators of wealth and rather than the inheritors of wealth. Now, whenever you see the creators of wealth having most of the wealth in a country or in a society, the focus is more on growth rather than preservation. But when most of the wealthy are actually the inheritors, the focus is more on preservation. So India being a country of creators, understandably, the focus is more on growth. India being the economy that it is, the focus is more on growth. However, something like COVID, maybe over the short term, tries to bring up the question on whether a blind focus on growth is something that is right or whether preservation of wealth needs more attention. So that question is something that is being asked by a lot of families, and a lot of family office professionals are actually encouraging this conversation between family members and trying to ask them if there is a fundamental change in their thought process from growth to preservation, or if there is at least an inclination to change that. Uh, Sorry, okay. Um, Again, while this is more long-term and strategic, the other thing that you would also look at is over the short term, are the cash flows changing? Because when you're talking about different kinds of objectives that the family has, all those objectives or the allocation to those objectives come from a particular assumption on cash flows. That if I have a family business, this is what I can expect out of it. Or if I have a business that I want to start, this is what I expect to put into it. Now, based on COVID, some of these assumptions would change. So if there was a new business that was to be launched, possibly that would, it based on the sector, it could either be pushed up or pushed down the line. So if it's something, for example, an education venture that one of the family members wants to start, maybe it's a good time to start that right away rather than waiting for another 2 3 years. So some cash flow that you had expected would come, an outflow that you had expected would come 2 years down the line or 3 years down the line would probably come right away. So you need to prepare for that. Similarly, if there was a liquidity event that you were anticipating in one of your companies, whether in the investment portfolio or in the operating portfolio that the family owns, possibly that liquidity event would be pushed further down the line. If you're planning for an IPO, maybe right away, but if you're planning for a strategic investment into your business by outsiders, maybe that'll be pushed further down the line. So based on how the pandemic has impacted different sectors, based on which sector you are in or your family is in, you may figure out that the cash flows have changed. And because of the cash flows changing, some of the fundamental assumptions that you had made while deciding on your allocations to different objectives would have changed. Um, the next thing that could have changed is the efficient frontier itself. Because the risk return paradigms that different asset classes have would again change or could change based on the kind of economy that we'll probably expect for the next 3 4 5 years. Although over the long term, the characteristics of the different asset classes would probably remain the same, But at least over the next 4 5 years, medium term, because of the way the central banks have reacted to the pandemic, the way different industries have reacted, the change in consumer mindset, um, the adoption of digital, the adoption of social media. So all those things probably would change the risk return characteristics of different asset classes as well. So does that change your efficient frontier itself? And if it does, then what is the new allocation for each of your objectives that you should be looking at? Uh, and this is also a test of all your models
That you had created right up front when you had created the investment policy for the family. Because if those models were right and if you had done the right kind of stress testing and modeling, then something
something like this would already be factored in and it would not really result in a lot of changes. But then tolerance that is stated versus tolerance that actually is, there could be a lot of difference. And all of us know that as investors, while we say that, we are okay with losing 50% of our portfolio, when actually 50% of the portfolio is lost, we are different people. So I think a reassessment of the efficient frontier also kind of brings to the forefront the robustness of your model or the robustness of the different kind of scenario analysis that you've done on your model, so that the family is now well aware that when you are actually talking about situations that could go wrong, you're not just talking about it in theory, and it could actually happen in practice. So whether or not the efficient frontier changes now, at least the family would be more understanding in terms of what are the kind of changes that could happen. Uh, and then the extent of tactical deviations and allocations. So while you've decided these strategic allocations, maybe those allocations don't change. Maybe your cash flows don't change. Maybe your growth versus preservation context doesn't change. Maybe the efficient frontier doesn't change for you. But even within the investment policy or the investment philosophy that you have, you may decide to change tactically or allocate higher or allocate lower tactically to a particular asset class. Obviously, all this has to be within a range. A tactical deviation does not mean that you can go to 0 or 200, but you could deviate tactically and you could allocate more or less to a particular asset class or a particular vehicle. Um, and things have and things don't just happen because you do it. There are a lot of things that are happening because the market is forcing your hand. Equity is being just going up all the way, and for a lot of people, the allocation to equity has gone up not because of what they have done, but purely because of the price movements. Now, do you rebalance in such a scenario? Do you allow this dispersion? At what stage do you rebalance? What is it that your investment philosophy allows for? What is it that you really want to do? So again, something which is a test of your investment philosophy and the investment policy that you have created for the family. Because a lot of times, while you've written something in the investment policy, when it comes to greed or fear, uh, the principles may tend to act not in line with what the investment policy says. But the true test of a family office with an established process, established guidelines, established professional team is that it kind of guides the family to follow the investment policy the way it is and not allow too much of a dispersion, not more than at least what is mentioned in the investment policy. So, provide for that rebalancing. So that's more on the broader investment policy. Then there are certain more internal things that one looks at. So is there an opportunistic entry that you can make into illiquid assets like, we discussed, where a lot of people are trying to look at illiquid assets such as private equity, infrastructure, real estate, which are available at somewhat of a distress, primarily because most of the money is going into public listed equity and fixed income and assets which are being priced very regularly because everybody is afraid of the uncertainty. So they don't want to put money into something which is not being priced regularly, where liquidity is not available. So a normal investor is preferring liquidity. So therefore, a sophisticated investor can find a good deal in illiquidity. So that is what is happening. A lot of illiquid assets are available at good discounts. So there is an opportunistic entry that you can make into those illiquid assets. On the other hand, you also need to ensure that while you should have liquidity, but it should not be at the cost of the portfolio return. Because if you try and maintain this liquidity for too long, then you end up into a scenario where you cannot recover from and where your returns on the portfolio get impacted over a long term. So how do you really find innovative ways to maintain liquidity and at the same time try and get more than what the short-term rates have to offer, which is hardly anything in today's scenario. So what kind of calls can you take there? So those are in terms of your investments. And then there are certain themes that have changed, and globally, obviously, impact and ESG have become big themes. And especially after something like COVID, you've seen people become more socially aware, more aware of their environment.
more aware of what they can do to help people, more aware of people themselves, whether it's employees that they have, whether it's the general society and what they can do for them. How do
They work together with other families, with other investors. So a lot of it now is moving towards collaborative investments, investments into things that can really impact the society, investments into things which have got good environmental factors, extremely high governance. So all those focus areas have become more prominent now, especially after COVID. And then, like we said, there are different sectors that have gained prominence, whether it's technology, cybersecurity, and digital economy for obvious reasons, healthcare and education, again, for obvious reasons, social media and consumer networks, because you see, again, social distancing, people not being able to meet physically, a lot of products, consumer products being sold online, the rise in direct to consumer companies. So the change in distribution models, because we've always seen, at least in India, most of the consumer companies relying on the distribution model, and their biggest strength not being the brand but being the distribution model. Today that entire premise is being challenged by startups who are really disrupting the distribution model and saying that, hey, your product is important, your brand is important, the distribution model can be changed. So those kind of companies have become a big attraction. You're also talking about some contrarian bets where you're saying that, okay, while there are some sectors that have been beaten down because of COVID, but it's not that this is going to continue forever and these things will come back. And therefore, can you look at some distressed valuations in those sectors and go ahead and invest in them today as a family office and make sure that opportunistically you are making money for your family, in the long term. So, this is as far as the investment pure numbers perspective is concerned, but at the same time, there are a lot of non-core activities that are happening, typically non-core, but I think more relevant for the investment philosophy than the other activities that we have discussed. Uh, and some of these are, the tendency to have more control and oversight over the portfolio. So while in the past, you may have seen family principles not giving too much thought to how the family portfolio is structured or what are the kind of investments that have been made, uh, and relying a lot on the professionals managing the family office or managing the portfolio. But with COVID, there has been a lot of focus on trying to maintain some level of control and oversight on this portfolio, trying to understand more, get involved more. Maybe if they have a portfolio of direct venture companies that they've invested in, talk to these founders of venture companies, try and figure out what is really happening on the ground. So COVID has really brought that into the limelight. A lot of people have now thought or started thinking about succession planning because they've obviously realized that life is not permanent, and there is something that you need to plan to ensure that the future generation is well provided for, that the transfer of wealth, the transfer of knowledge happens from one generation to another. The transition is smooth to the next generation. People have started looking around the globe for opportunities and not restrict themselves to one particular country because like this pandemic has hit India differently, US differently, China differently, Europe differently. Similarly, tomorrow there could be another event which could affect different geographies differently. So you need to have a diversified portfolio. You need to be present across the globe. So you're trying to do that. Philanthropy is again becoming very relevant because of what has happened, because of so many people who've lost their lives, who've lost their livelihoods. Family offices, large business families have realized that they can really help. They can really participate in the recovery, in trying to ensure that people come back. The economy comes back. People who are participating in the economy come back. So there is a lot of charity, there's a lot of philanthropy that is happening, which is getting more structured by the day. And ultimately, you are trying to attract talent as well to ensure that all these things happen. You're trying to make your family office setup more professional. So these are the changes that are happening in the non-core activities. I will now stop the share. And I think broadly, what I wanted to talk about in this context is this. And I think we are done with our first 40 minutes. So I'll be happy to, if there are any questions, either on the chat or you'd like to just unmute yourself and ask, that's also good. Okay, so I have a question about what is ESG. So ESG stands for environmental, social, and governance. So any investment that is relevant from these 3 points of view is ESG. So now, increasingly around the world, people are focusing on businesses, on investments which are relevant and which are or which score high on these 3 parameters, parameters of the environment, parameters of society, and parameters of governance. So people are looking at very high governance standards. People are looking at companies or businesses or investment opportunities which have a positive impact on the society and obviously on the environment. Okay, I have another question that says prospective planning tends to undergo change over time. How do you take care of the changing scenario? So absolutely. So planning does undergo change over time, but you need to break it down into what kind of change, because the change will also depend on whether it's a change in your thought process, whether it's a change in your cash flows, whether it's a change in numbers, or it's more a change in your head. So based on what kind of change, you'll have a corresponding impact on your investment philosophy. So if it's just a change in your head, then either you come around to trying to see if it's something which is really fundamentally changed, or is this just your fear talking? Can you rationalize that change in your head? But if it's actual change in numbers, and things have changed in terms of numbers itself, then definitely you need to see and figure out if it means that you need to change your investment philosophy completely. The question is if there is any increase in investment opportunities in India by global family offices, particularly in Indian equities. Definitely a lot of interest in India, across the world, and a lot of family offices as well as funds are now looking at India. Unfortunately, there are still a lot of issues that India has in terms of transparency, in terms of the governance, in terms of the governance standards of different companies, even in public listed companies. So a lot of foreign investors, whether it's family offices or funds, are actually going the fund route to invest in India rather than investing directly. So they're looking at funds which invest in the emerging markets, and India is a part of that bouquet. There are some people who are slightly more adventurous, and they're tying up with an Indian investor and trying to piggyback on the Indian investor, and through that Indian investor invest in India. So directly investing into India is something which is still not very common. Then there is another question says, from your experience, what generally is the ratio between financial and non-financial assets that the family offices hold? I'm assuming that when you say non-financial assets, you mean immovable assets and physical assets, so which cannot be liquidated. So I'm assuming that's the question. So typically, I think assuming that you would count real estate and you would count, or at least physical real estate, you will count jewelry, and you'll count the core family business as non-financial. Then I would say for a family office, typically that range is, I think the allocation to financial assets would probably be around 25% to 30%, because still in India, most of the wealth is locked into the core family business. Not so much in real estate anymore. It used to be real estate too in a big way, but a lot of families have now started getting out of real estate and liquidating their positions and getting into financial assets. But the core family business still is if you consider that a non-financial asset, a pretty significant number. And then likewise, are Indian family offices actively exploring investments in other geographies since COVID times? Definitely. Like I said, globalization has become very relevant because a lot of people, Indian family offices have realized that any anything that impacts one country need not impact the other countries in the same way. And it makes sense to have a diversified portfolio across countries, across geographies, so that if your country is impacted in a big way, at least there is some country in the world where your portfolio is not doing as badly. But again, the information asymmetry is there even in that case for us to go and invest into something outside. The best way to do that would be to partner with somebody locally and try and piggyback on that particular partner, that particular family, that particular fund, and then go ahead and invest. What is the break-even net worth level to set up a family office? Okay, so again, there are different kinds of family offices, and you could set up a single family office. You could actually avail the services of a multi-family office. So based on the kind of assets that you have, based on the kind of complexities which are there in your family's dynamics, in your family's requirements, you could start with something which is maybe 100 crores of investable surplus for a multi-family office, and maybe 1,000 crores investable surplus for a single family office. Again, very rule of thumb numbers. These could be different for different families, but I think 100 crores for availing the services of a multi-family office, and maybe 1,000 crores to set up your own family office. Nobody predicted the COVID situation. It could not have been part of the investment policy of family office. How drastic or rapid has been the change in investment policies of family offices? So while nobody could have predicted the COVID situation, but when you create these investment policies, you don't know what would impact or what would bring that downturn. But you would build these investment policies in such a way that a downturn is built into it. So you'd say that, okay, let's say there is a situation where 50% of all your listed equity markets go for a toss. Now, why that 50% will happen, whether it will be because of COVID, whether it will happen because of World War III, whether it will happen because of depression in global markets, that we can't anticipate. But we can definitely anticipate that there could be some change that will happen on the downside. So is your investment policy robust enough to take care of that downturn? If that downturn happens, do you necessarily need to change? If you've created a robust investment policy, if you've taken the family through different kinds of modelings and simulations and scenario analysis, and showed them that, okay, if something like this happens for whatever reason, this is what you'll see in your portfolio, and are you okay with it? And if they say that they're okay with it and they actually walk the talk, then I don't think that there is going to be a lot of change in the investment policy of family offices. Unless obviously numbers change, which is where I said that if it's in your head, you can work around it. But if it's numbers, you will definitely need to tweak around slightly with the kind of allocations, with the kind of risk return expectations that you have from different asset classes. What is the fee structure of outsourced family office? Not relevant to the current topic, but typically ranges anywhere from a flat fee kind of a structure to a fee based on the assets which are being managed. So it could either be a flat fee or anything that ranges from 25 basis points to 100 basis points on the amount of assets being managed. Does it make sense for an India-based family office to set up an investment office overseas, example Singapore, to make any investments from a tax efficiency perspective? To make India investments, you will need to have money outside. You can't take money out of India and invest again back in India. If you have money outside and you can take money outside in a way that you can reinvest in India, why not? Because if you have an investment office set up in, say, Singapore or a DIFC in Dubai or one of the other places, you have a more global perspective. But at the same time, a lot of family offices that are there in India, which have a core family business attached to them, are so engrossed in India as an economy that it becomes very difficult for them to separate themselves out and set up a facility outside. However, for people who have maybe sold their business and got into liquidity and they're setting up a family office because of with the liquid money that they have got by selling the business, for them, yes, it makes sense if they can get that money out in such a way that they can reinvest in India. Of course, it makes sense to set up something outside. How can one create awareness among big families on the need for a family office and the need for professional advice? I think a lot of that awareness is already coming in because of efforts of people like Aditya, who've created these platforms where people like you and me meet and we talk about family offices. We talk about why a family office is needed and how a family office is managed professionally. I think that that awareness is already coming in. Apart from that, a lot of the next generation is coming from the West, having seen family offices operate there, having seen how family offices work very well. They're coming back and they are telling their parents or they are convincing their parents of this. So I think it's just a matter of time. I don't think it will need a lot of convincing. It'll probably happen sooner than later. Do family offices also provide legal and taxation consultancy? They don't. Okay, so for the family offices ideally are one-stop shop for everything. So while they may or may not have internal resources to provide legal or taxation advice, but they will definitely have empaneled advisors, uh, both on the legal side, taxation side, structuring side, etc. So if the family needs something, they will go to their family office, whether in-house single family office or an outsourced multi-family office, and they'll tell them that, this is my legal requirement, this is my taxation problem, and then they would in turn, the family office would in turn consult with the external advisors, or if they have an internal resource, they will try and see if they can provide a solution. Um, how should newly established VC funds reach out to family offices? A difficult question because newly established VC funds, normally a lot of family offices don't invest in. They have they have a kind of a requirement where they say that they want to see the track record of an investment product before they invest in it. But again, I mean that's not true for every family office. But most family offices like to see that track record. One way in which you can do that is instead of going to the family offices for the first close or expecting them to invest with you in the first close, try and go to them in the first close, but maybe take them through from the first close to the last close, which normally for a VC fund takes about a year. So in the process of that 1 year, you take them through the kind of investments that you've made over that 1 year and try and give that confidence to the family office that while you're a first time fund, but you've stuck to your mandate of investing and what you had promised when you had come to the family for the first time during your first close, you've kind of stuck to that and you've made your investments according to it. So near to the final close, you may expect the family offices to maybe pay more attention to you. The V-shaped recovery in the stock markets has brought euphoria amongst even HNIs, and they don't seem to understand the conversations around robust investment strategy we have built in their portfolios. Share your experience around conversations you're having the current scenario with your clients. Okay, so in my case, there is just one client because I manage a single family office. So won't be right for me to share the conversation that I've had with that client. But typically, I think I understand what you're saying, and euphoria as well as fear on the other side generally takes over when it comes to extreme market situations. But then it's the job or responsibility of advisors like us to ensure that we take them through the basic tenets of the investment policy and the investment philosophy every time something like this happens, and try and bring them back to
bring them back to what is there in the investment policy. I know it's
sounding more theoretical than practical, but believe me, I think investors have also become more mature now that they have seen different cycles. So the Indian investor no longer is the investor 10 years ago. The investor is much more nuanced, especially the family offices. They have seen what happened during 2008 and all the way till 2019. They are seeing this. They Some of them even saw what happened in 2001. So I think it's not that difficult to explain to them, why it makes sense to stick to an investment philosophy and why it makes sense to stick to an investment strategy. So while you are seeing 50% returns on the portfolio in this financial year till date, you could see 5% portfolio return the next year or negative returns the next year unless you stick to a particular investment strategy. And that is where scenario analysis, modeling, simulations, all of those work very well. Do we see any movement of investments to Vietnam and Malaysia as they become alternate to China and hence have a scope for economic growth? I'm sorry, I haven't really followed Vietnam and Malaysia so much, so I won't be able to answer that. But yes, alternatives to China, including India, have become very relevant globally, not just for Indian family offices. So definitely there is a lot of opportunity for Vietnam, Indonesia, Malaysia, India when it comes to giving investors an alternative to China. Not really very specifically aware about what is happening in Vietnam and Malaysia, though. How do we generally diversify for family offices? So diversification could be in terms of asset classes, could be in terms of geographies, could be in terms of currencies. So a lot of ways in which you diversify. But like I said in the beginning, it starts with setting your objectives, starts with having different portfolios which are tailored for different objectives. And once you have those portfolios, then within those portfolios, you decide how diverse you want it to be. So, for example, something which is meant for meeting a safety objective doesn't need to be very diverse in terms of asset classes. You know that you need to invest that money into debt and nothing else. Again, something that is going to go into meeting the growth objective will be invested in growth assets, whether it's real estate, whether it's infrastructure, private equity, venture capital, so those kind of asset classes. So by the nature of the objective, you'll realize the kind of diversification that you need for that particular portfolio. And you need to maintain these multiple portfolios, each portfolio tailored for meeting one particular objective. And based on the nature of the objective, you'll decide the diversification. And obviously, you can have the geographical diversification. Is hurdle rate a common phenomenon in FOs? Of course. I mean, any investor looks at a hurdle rate. Again, hurdle rate, there is no single hurdle rate for the family offices. Like I said, there are different objectives, and each objective carries a different portfolio. So every portfolio will have a different hurdle rate. So, for example, a safety portfolio will have inflation as the hurdle rate. A lifestyle portfolio will have the GDP growth rate plus inflation plus maybe some alpha as a hurdle rate. A growth portfolio, that alpha will be higher. So based on the kind of building block that you have for a particular portfolio, you'll decide the hurdle rate for that portfolio. I don't think that having a blended hurdle rate for the overall family office makes sense. Okay, I think I've covered all the questions.